In this Chapter 6 tutorial, we're going to go through accounting for merchandise inventory. The main topics is going to focus on what we call inventory costing method. Now, we learned in Chapter 5 that when you have a merchandising operation, the company will buy inventory and then they will sell it. The question is, though, if inventory prices are always changing, how do we account for the cost of goods sold? Do we use the cost of goods sold based on the inventory that we bought earlier or the inventory that we bought later? And so if we look at the first page of this Chapter 6 handout, there are basically three inventory costing methods that are accepted. The first one is called specific unit or specific identification. The next one is called weighted average. And the third one is first in, first out. Now, all of these are acceptable inventory costing method, and the company should select the one that best represents their actual flow of inventory. So let's talk about the first one, specific unit, specific identification. This is often used for high-end inventory items or things that are custom made. So for example, cars, jewelry, maybe antiques, they may use this specific unit or specific identification method. They're going to sell probably not that many of these items. So they're going to buy the car from the manufacturer, and then when they sell the car, they're going to use the exact cost of that car as their cost of goods sold. So have a look at exercise 6-1 on page 348, 349. So let's turn to that page now. Pause the video, have a read through 6-1, and then once you've had a chance to review the question, then come back and we'll resolve that answer together. Okay, let's have a look at this exercise 6-1 and this specific inventory costing method. So for exercise 6-1, we have this company that sells transformers, and they bought a bunch of transformers. There's 4. There was 2 on hand at the beginning of April, and then during the month they bought 2 additional ones. And if you notice with these transformers, they have quite a high unit cost, and so their method that they're going to use is specific unit cost or specific identification. So whenever they sell a transformer, the cost of goods sold that they use will be the exact cost of the inventory that they bought it for. So if we look at what they require from us, they ask us to calculate the gross margin. Now, if you remember back from Chapter 5, gross margin is equal to our sales revenue minus our cost of goods sold. So the sales revenue is pretty straightforward. The company sells the transformers at $90,000 per unit, and during the month of April, they sell 2 of these. So their total sales revenue is going to be $180,000. Now, in terms of their cost of goods sold, because the specific unit cost is the most appropriate costing method, because these are high cost items and there's not a huge volume of sales, that's the most beneficial, the most appropriate method to use. So we're told that the 2 transformers they sold are the ones with serial numbers ending in 905 and 002. So the cost of goods sold then, this number here, is going to equal $59,200. That's the specific cost of the transformer with serial number ending 905. And the specific cost of the other transformer, the one ending in 002, is $56,800. So the total cost of goods sold is going to be $116,000. And so the gross margin or gross profit, remember those 2 terms are interchangeable, is going to be $64,000. So that's an example of specific unit cost, also known as specific identification. And once again, the reason you would use this method is because you're selling, let's say, high-end items or unique type items, and there's not a lot of volume, so that way you can actually match the specific cost with the inventory item that's being sold. So let's go back to our handout and let's look at the other 2 methods. So we've dealt with specific unit And now we're going to talk about weighted average. Well, weighted average, also known as moving weighted average, if we're looking at the perpetual inventory system, this is going to be used for items that we basically maybe sell in bulk. Maybe items that are non-perishable. Perishable are items that spoil quickly. So non-perishable items that maybe sell in bulk or that we sell a lot of, we might use a weighted average cost. So for example, think about nails in a hardware store. If you go to a hardware store, they sell a bunch of different sizes of nails. And so usually in the bin, once the bin starts getting a little bit lower, the employee will maybe fill up the bin with a bunch of new nails, and they're going to be mixing the old and the new nails together. And so they're going to use an average cost for determining the cost of goods sold. Now, the third method is known as first in, first out. And this often represents the physical flow of goods. Think about going to a grocery store that sells a lot of perishable goods. When you go to the dairy aisle and you open the case to take some eggs or some milk, the inventory is being loaded from the back. They push all the old inventory to the front, and all the new inventory is at the back of that case. So the older inventory, what they bought first, is what they sell first. And so once again, depending on the type of company, they have to choose one of these three methods. So what I want to do then is have a look at these two exercises first, 6-2, 6-3, which uses the FIFO method. And then we're going to use the same data and look at exercise 6-4. And once again, these are on page 349 in your textbook. So pause the video here, read through these three exercises, and then once you've read through the exercises, come back and we'll solve these together. Okay, let's have a look at exercise 6-2. So with exercise 6-2, if you read the question, it says, prepare a perpetual inventory record for the guitars. Now, you can use an inventory record like the textbook shows you in the chapter 6 material. However, we can always just use a T account. Actually, I think a T account might be a little bit easier. So let me just sort of show you what I mean by using a T account for a perpetual inventory record. So we have our inventory T account. And remember, inventory is an asset, so the debit side represents the increase, the credit side represents the decrease. Now we know that at the beginning of May, we have 5 units of inventory at $900 per unit. So the total value of the inventory at the beginning of the month is $4,500. And then on May the 6th, we're going to sell 3 units. Now, because we're using FIFO, first in, first out, whatever we have first on hand is what we sell first. Now, we know that whenever we sell 3 items, that's going to decrease the inventory value. And because all we have is 5 units, and they're all at $900 per unit, the cost of goods sold is going to be $2,700. So after that sale on May the 6th, we now have 2 units of inventory left at $900 per unit, and so that's going to equal $1,800. So this is actually similar to what the textbook refers to as the perpetual inventory record. It basically just shows the flow of inventory coming in and being sold on a chronological basis. Next, what happens is on May the 8th, we purchased 10 units, and now we have a different price. Now we have 10 units at $840 per unit. That's going to increase our inventory by $8,400. And so that's going to give us a total inventory cost of $10,200. And now we have a total of 12 units. But because we have them at different cost amounts, we have to sort of, and remember that 2 are at 900 and 10 are at 840. And then we get to the next transaction on May 17th. And this is where we sell 4 units of inventory. Now, because we're using FIFO, the first 2 that we sell are going to be the oldest units. Those are the two at 900. And then the last two that we sell are going to be the more recent purchases. Those are going to be at 840. Now, if you work through the math, the cost of goods sold then is going to be 3,480. And so what do we have left? Well, we have inventory of 6,720. We had 12. We sold 4. Now, the first two that we sold were the ones at 900, and then the last two that we sold were the ones at 840. So all we have left then is 8 units at 840 each, and that gives us the 6,720. Now, we can just finish off the question. At the end of May 30th, we purchased an additional 5 units, and these are also at $840. So that's going to increase our inventory by 4,200. And so at the end of the month, our inventory account is 10,920, and that represents 13 units, all at $840. So 13 units at 840. That's our inventory value at 10,920. So that is exercise 6-2. Now, what I want to do now is move to 6-3. It says, after preparing the inventory record, journalize the May 8th purchase on account, and then the cash sale on May 17th. So now all we're going to do is record some of these journal entries. Now, let's look at the May 8th purchase. On May 8th, and once again, we're doing journal entries. We purchased 10 units at 840, and this is all on account. So once again, fairly straightforward. All we're going to do is debit our inventory account for the amount of 8,400 and credit our accounts payable for 8,400. So fairly straightforward. Now, the next journal entry is for the May 17th sale. Now, once again, we're not doing all the journal entries, just the ones that the textbook asks us to do for exercise 6-3. Now, whenever there's a sale of inventory and we're using the perpetual inventory method, remember there's 2 journal entries, one to record the sales revenue and one to record the cost of goods sold. Now, we know that these units are sold for 1,600 each. That's given in exercise 6-2. And we sold 4 at 1,600. So that's going to be a total sales revenue of 6,400. So let's record the first journal entry. This is a cash sale. So we're going to debit cash for 6,400, and then the credit goes to our sales revenue, 6,400. Now we have to record the cost of goods sold. And if you remember from our inventory T account, the cost of goods sold is going to be 3,480. And remember, cost of goods sold is an expense, so we're going to debit cost of goods sold 3,480, and the credit will go to our inventory account, 3,480. So that's the 2 journal entries for exercise 6-3. Now we're going to go and look at exercise 6-4, and we're going to go back to the same data for 6-2, but now we're going to use what we call the moving weighted average cost method. Now remember, the moving weighted average cost method, that's useful if we're selling, for example, non-perishable, bulk type items. And so we're just going to use the same data. And once again, we're going to use a T account to demonstrate how we have to calculate an average cost for our inventory. Now, the average cost needs to be calculated after every inventory purchase. Not when there's a sale of inventory, but after every purchase, we have to calculate a new average cost. And that's why it's called a moving weighted average, is because that average cost is always changing. So let's take a look at exercise 6-4. Now, once again, all I want to do is demonstrate this by using an inventory T account. So we have our inventory T account, And all we're going to just show you is how the average cost changes and how we calculate the cost of goods sold. So once again, we're starting off with 5 units at $900. That's 4,500. Now the average cost per unit is 900. That is simple for this starting point. Now we're going to sell 3, and because we only have one set of inventory, they're all at a cost of 900, we can use that 900 for our cost of goods sold. So that's fairly straightforward. So now we have 2 units at 900. That's the 1800. And then we buy 10 units. So now we're going to buy 10 units. And this is at, once again, 840. So our inventory is going to increase by 8,400. Now remember we said that whenever we buy inventory, we have to calculate a new average cost. So our total inventory cost is 10,200. We have 12 units of inventory. So what's going to be our average cost? Well, 10,200 divided by 12, so 10,200 divided by 12, our average cost is going to be 850. And so that's what we use now when we calculate our cost of goods sold moving forward. So if we look at the next transaction, on May the 17th, we sell 4 units. So when we sell the 4 units, we are now going to use an average cost of 850. This is our new average cost. And so the cost of goods sold is going to be 3,400. So this is going to be our cost of goods sold for the sale on May 17th. And now we do a new subtotal, 6,800. And so our average cost is still the same, right? Remember we had an average cost of 850. We sold 4, we used an average cost of 850. So now all we have left is 8 units at an average cost of 850. Now we get to the final transaction for May. Now we're going to buy 5 units at 840. So remember we said every time we make a purchase of inventory, we have to calculate a new average cost. So there's 5 units at 840. This is going to increase our inventory by 4,200. So our inventory value is now 11,000. Now we have to calculate a new average cost. We have 13 units. And now we got to figure out what is our new average cost. Now, if you work this out, 11,000 divided by 13, that's going to be $846.15. Now, the textbook says to round all amounts to the nearest dollar. So if we were, let's say, maybe doing this on my accounting lab, we would just round this to $846. But that's an example of the moving weighted average cost method. We have to calculate a new average cost every time we make a new purchase. So let's go back to our handout and let's move down to page 2. So we've done these exercises here. Let's move down to page 2. Now on page 2, the textbook refers to, talks about some income effects of the different methods we use, depending on whether you use specific unit costs, weighted average, or first in, first out. That's going to impact your cost of goods sold, which could impact your net income. So read through those paragraphs in your textbook. There's also some accounting concepts that the textbook talks about as well. So those are fairly straightforward. You can read through those concepts on your own. The next item I want to talk about is this rule called lower of cost and net realizable value. Sometimes a company might buy some inventory at a particular cost, and of course they want to sell it at a higher price. But let's say what they can sell it for drops below that cost. This concept says that we always have to value inventory at the lower of what we bought it for, or the net realizable value. Think about the net realizable value as what we can sell it for. Read through this example here. We have a bike shop owner The bike shop owner was clearing out their warehouse and they found a bike that was purchased over 3 years ago. Now, when they bought it 3 years ago, they paid $400. Now, they had planned to sell it for $550, but now that the bike is 3 years old, and because there's newer models on the bike market, the bike will likely only sell for $350. So the question is, how should the bike be valued for inventory purposes at year end? And once again, we can just draw a T account just to sort of explain what we're trying to how this rule will apply. We have this bike that has an inventory cost of $400. Now, we bought it 3 years ago. We still have it in inventory. We haven't sold it yet. Now, when we get to the end of the current year, we have to value that at the lower of cost, or net realizable value. Cost is $400, net realizable value is $350, so the lower amount is going to be $350. And what that means is we have to make an adjusting journal entry to reduce this by $50. And that's this adjusting journal entry that we have here. So this adjusting journal entry that we have to make, we're going to have to debit cost of goods sold by $50 and credit inventory by $50. All we're going to do is, because we cannot sell it for more than $350, we're going to absorb that $50 loss and we're just going to record it as an expense cost of goods sold. So that's an example of how we apply the lower of cost and net realizable value. Moving on, the textbook talks about inventory errors. So just read through these 2 pages on your own in the textbook. And the final topic that we're going to talk about is estimating ending inventory. Now, there are times when sometimes a company may have to estimate their ending inventory. Maybe it's impractical. Maybe it's too costly to go around and count all their ending inventory, or maybe it's impossible. Maybe there was a fire or a flood and all their inventory was destroyed. And in order to file the insurance claim, they have to estimate their ending inventory. So there's 2 methods of doing this, the gross margin method and the retail method. We're going to work on the gross margin method first, starter 6-14. So have a look at page 348 and look at starter 6-14. So pause video here, read starter 6-14, and then once you've read the question, come back to the video and then we'll work through the problem together. So let's have a look at starter 6-14. We're given some information of the company's beginning inventory, their purchases, what their sales revenue and their gross margin was for the year. Now, when we use the gross margin method to estimate ending inventory, think about the cost of goods sold equation. Remember the cost of goods sold equation? Beginning inventory plus our purchases, that equals our goods available for sale. And remember we said our goods available for sale, we're either going to sell them and that becomes our cost of goods sold, or they're going to remain unsold and that becomes our ending inventory. So what we could do is, if we knew our cost of goods sold, then we could figure out our ending inventory, and this would be our estimate. This is the gross margin method. So let's actually fill in what we know. We know that beginning inventory was $1,400,000. Our purchases totaled $3,200,000. So our goods available for sale, $4,600,000. Now we don't know our cost of goods sold, and what we're trying to figure out is what is our estimated ending inventory. So what we can do now is figure this out by looking at our sales revenue and our gross margin percentage. So sales revenue is given to us at $7 million. Now we know that if we took our sales revenue minus our cost of goods sold, that would give us our gross margin or our gross profit. Now we don't know what these amounts are, but we do know that our gross margin percentage is 45%. So this is going to be our 45%. Remember, 45% gross margin is basically our gross margin divided by our sales revenue. So if we knew what the dollar amount for the gross margin was, we would just take that, divide it by our sales revenue, and that would give us 45%. What we do know, though, is that this number represents 100%. Our sales revenue is the 100% number. If we were to minus 55%, that would give us our 45% gross margin. So all we're going to do then is just use these ratios here to figure out what these missing dollar amounts are. If our sales revenue represents 100%, then 55% of 7 million would represent our cost of goods sold. That's going to be 3,850,000. And the remaining 45%, or if we just do the math, is going to be our gross margin, 3,150,000. Now, remember we said that gross margin percentage is gross margin. Now that we know that our gross margin is 3,150,000, if we divide it by our sales revenue of 7 million, that's going to give us our 45%. So this is the gross margin method, and this is used to first figure out what is our cost of goods sold. Now that we've figured out our cost of goods sold, we can bring that number back to our calculation here and then figure out what our ending inventory is. So our ending inventory for starter 6-14 is 750,000. So that's an example of the gross margin method to estimate ending inventory. Now, the next method is known as the retail method. And this looks at the ratio of the cost of goods available for sale based on cost to the cost of goods available for sale at the retail selling price. So let's have a look at starter 615. Now, once again, read through starter 615 first, pause the video here, and then once you've read through the question, then come back and we'll solve this together. So let's have a look at starter 6-15. Now, this one's a little bit more complicated, not as simple as the gross margin method, but once again, as long as we follow the steps, we'll be fine. Once again, think about your cost of goods sold equation. Beginning inventory plus our purchases, that's going to give us our goods available for sale. Now, if we look at the question here, we know that last year's balance sheet, we had ending inventory of 15,000. So the beginning inventory for this year is going to be 15,000. Now, what we're going to do is list the amounts at cost and also at retail. So in the question it says that this $15,000 of inventory would usually sell for 40,000. So the beginning inventory has a cost of 15,000. If we were to sell it, the retail selling price would be 40,000. Then we had some additional purchases. The cost of the purchases was 140,000. So we know that the goods available for sale at the cost is 155,000. Now, these purchases that cost us 140,000 would have a retail selling price of 290. So if we express it at the retail selling price, our goods available for sale at the retail selling price is 330,000. So if we sold all of our inventory, we would have a selling price or sales revenue of 330,000. Now we have to calculate what we call the retail ratio. The retail ratio is basically going to be our cost of goods available for sale at cost the cost of the goods available for sale at cost divided by the goods available for sale at retail, which is the 330. And this is going to give us a ratio. And once again, let's just round this to 4 decimal places, so 0.4697. So the retail ratio is the cost of the goods available for sale at the cost divided by the goods available for sale at the retail price. And so this is going to give us our retail ratio. Now, what we can do then is now utilize that retail ratio. So we think about it, if we were taking 330 and we times it by the 0.4697, that would give us the 155. So try this on your own. Go to your calculator, 330,000 times the retail ratio, 0.4697, that would give us the 155,000. We know rounded, it goes to $155,001, but that's because we rounded this retail ratio to 4 decimal places. So now what we can do is we can now work through the retail column. So what else do we know? We know that there were 255,000 of sales since the beginning of the year. So of this let's just focus on this column here. Of this 330,000 of inventory at the retail price, we sold 250. Remember, everything is being expressed at the retail price now. So that means that the ending inventory at the retail price is going to be 75,000. So we have goods available for sale expressed at both the cost and expressed in the retail price. Now, if this is the goods available for sale at the retail price, and we know that we actually sold, we made actual sales at the retail price of 250,000, this would be our ending inventory left over at the end of the year based on our retail price. So now all we got to do is just convert this back into the ending inventory at cost. And all we have to do now is just multiply the 75,000 by the 0.4697, and our ending inventory at cost is going to be 35,228. 35,228. So that's the answer to the estimated cost of ending inventory. So that's the retail method of how to estimate ending inventory. And just to wrap up this chapter 6 lecture, on the very last line here, this is a really good question to do on your own. And once again, you can use T accounts instead of the perpetual inventory method, just like what I showed you earlier in this video tutorial. There's also some additional solutions from the textbook posted on D2L Brightspace. There's good examples, good summary problems. There's the try it questions. There's the self-study questions, which represent multiple choice questions in your textbook where the solutions are provided. So use these additional resources to practice the chapter 6 topics. Also go to my accounting lab, and you can use that for extra practice as well. And don't forget to keep up to date with all your homework and quizzes on my accounting lab. So that brings us to the end of this chapter 6 tutorial. Good luck with your studies, and we'll see you in the next video tutorial.